We have a lot to cover today, but before we do, JP Morgan has teams to support you at every stage of your growth. As former founders who have worked in local markets themselves, the bankers at JP Morgan bring deep sector knowledge and lived experience to their clients. JP Morgan can help you navigate complexity with confidence, backed by real-world insights and an entrepreneurial perspective. Get what your startup needs now at jpmorgan.com/grow-without-limits. JP Morgan is the bank of the innovation economy. And welcome to the Tearsheet Podcast, where we explore financial services together with an eye on technology, innovation, emerging models, and changing expectations. I'm Tearsheet Editor-in-Chief, Zach Miller. And the venture capital world has a liquidity problem. With IPOs scarce and M&A exits few and far between, investors have been stuck in positions for years, unable to return capital to their LPs or move into new opportunities. But while traditional exit doors have stayed shut, technology has opened up new ones, specifically platforms that make it possible to create and trade special purpose vehicles at scale, something that used to require armies of lawyers and fund administrators. Today, I'm joined by Nik Talreja, CEO and co-founder of Sydecar, a platform that's turned what used to be a manual months-long process into something you can do in days. And I know that because we launched a vehicle on Sydecar a few months ago for our Fortify investors. Nik started his career as a securities attorney at firms like Weil Gotshal and Cooley, where he spent his days drafting the same documents over and over for venture deals. That experience showed him that much of what venture capitalists were paying lawyers to do could be standardized and automated, which led him to found Sydecar in 2021. And in our conversation, I hope Nik will explain how technology is reshaping private market infrastructure, what gets automated and what still needs human expertise, and how software is changing who can participate in venture investing. Nik, welcome to the podcast.
Thank you for having me, Zach. Pumped to be here.
Hope that was an accurate intro. So I want to hear how your experience as a security lawyer informed your decision to start Sydecar. What were some of the issues you faced there, and how are you solving for them?
You know, I never wanted to be a lawyer, but now looking back in the dots, I'm so glad I went to law school and became an attorney because it led me to ultimately to Sydecar. In the practice of law, what's interesting is that if you have an entrepreneurial spirit, it tends to be battled by everything you do because as an attorney, you're forced to follow precedent with everything. You're not supposed to innovate. Innovation.
You can't move fast and break things.
You can't move fast and break. Try to do something that may be 10% more efficient. It could lead to litigation, right, in a contract. So you just don't want to reinvent things. You want to do the tried and true. That experience definitely shaped me and kind of, for me, underlined how much I wanted to be a creator and wanted to break out of precedent and try to do things differently, especially given the world of securities law and corporate law, which is very much an archaic system that's intentionally built upon precedent so that there isn't uncertainty. But I would see left and right how the things we were doing for our clients would take me sometimes minutes, yet would still cost our clients thousands of dollars because of the repeat reviews and everything else I had to go down process-wise at a law firm to get jobs done. So even if a contract took me minutes to draft, it may still require review from a senior partner and then go to a paralegal to be, sent via DocuSign to somebody and chased down to get different things done, which ends up costing thousands of dollars for a job that really could be far more simple, right? And how things are executed. That was like a learning as an attorney was like, I'm an innovator. I like to create things. I don't think corporate law is for me long term. The second thing for me was on this journey of being a lawyer was starting my own law firm after I left Cooley in Palo Alto. I had a number of really awesome clients that I got to work with very closely since I had my own firm. I could do what I wanted with them to some degree. I could spend time with them at the board level, and I joined a couple of boards. I could invest in them, and I could follow their journey more deeply than just a counsel might. And, it was like that investing journey with my clients that opened up a whole other chapter for me. Because I started to do what you do, Zach, through your syndicate, is I started to think about backing these founders with my community because I cared so much about their journeys. And as you know, founder stories are super infectious. I would just get captivated by them. And I'd be like, I want to put money in your company. I want to bring money to your company. I want to be a part of this story. And as I started to syndicate deals behind some of my more successful clients, I felt the pain of working with a lawyer myself to get documents drafted, right? I had to do the job, go to a bank to open a bank account, work with an accountant to maintain all the records for the SPVs I was creating. And it dawned on me that an SPV is a really simple structure. It's kind of like a safe if you're a company raising a round. Like, it's just no need to negotiate all these terms. If we could just create a static document that has really just, well understood terms and then just change the few parameters that people actually care about, you can create almost like an end user license agreement, like a EULA. You can just click through it rather than have to negotiate it. And then that would enable you to automate all of the downstream implications of running an SPV business. And that was an insight that kind of like, I fell upon as an investor, as a syndicate lead, which then led to Sydecar, and realizing that I could build this product for myself. And I didn't know what else would be out there for this product. I kind of figured I'd dog food and see where it'd go. And maybe it's a hack for deal flow where I could share with other investors and join their deal flow. And it ended up turning into its own business and became something I just got obsessed with. And now we're here.
That's awesome. So it sounds like there was an unlock in standardizing the SPV structure itself.
That's correct.
Okay.
Yeah, that was a big
and so that's a legal issue, that's a process issue. How does that lead then to sort of the ancillary things that you do, and why is that the leg in? Why is that the gating factor for doing more deals, automating more deals, being able to do what you guys do?
Yeah, an insight I had early on was that the legal form dictates all of the support work over the life of a private investment, over the life of an SPV, right? So if you could standardize that legal form up front, you're now standardizing how capital accounts are maintained, how a waterfall operates, how distributions are processed, tax matters, books and records, right? The whole 9 yards of running essentially a fund, that SPV that is a fund over the course of its life. So standardizing legal form allows you to standardize all these downstream processes that are otherwise difficult to standardize because varying legal forms have to be interpreted by like a fund accountant in different job of creating and maintaining the books and records of capital accounts for each SPV or each fund they maintain. So the insight on standardizing forms enabled us to standardize the downstream processes, which then enables you to apply software to handle those jobs, right? To kind of build basically like a calculator for all the downstream jobs to be done.
It's interesting because like the previous generation that tackled private investing sort of focused on fundraising and not actually on the structural, on the procedural stuff. I think when you started with the background that you started with, I think addressed what you said is really the core part of the problem, not the fundraising piece.
Right. At least for the problem that I geeked out on, right? I'm a wonk for some of this process stuff. And like, I think about the changing compliance landscape and whatnot, just because I'm still trained as a lawyer. I think I was well suited with my co-founder to solve this particular problem. I think fundraising is probably the bigger problem for most people. My goal, the actual running of a fund, right? The maintaining the fund is just something you have to think about. You can focus more on the relationship side.
I have to imagine then you've thought about, at least at the product level, of being able to enable that type of movement or fundraising in the future as part of a feature or a product rollout.
Zach, we very much like the picks and shovels aspect of our business, where we don't give you the tools and we don't create like a market around what we do, so that we're never competitive with our customers or in conflict with their ambitions. But we may end up talking about where the private markets are headed. I think what's super interesting is that what our customers are doing today are investing in businesses that will stay private for very long. And increasingly, everyone wants to get access to these businesses that are growing in the private markets. How do SPVs play a role in that? I think there's a chance for us to be some connective tissue for folks like yourself as your portfolio matures, to then hand you off to someone that might be interested in some of your better performing companies. But that's something we're thinking about now.
So maybe we can zoom out and talk about some of the trends that are happening in the space. Who are the players? How are private investments being made? What companies are raising that way? How long are they staying private? Your insight would be really interesting, I think, for our audience.
Of course. Yeah, I can start where we are and then zoom out to sort of the broader landscape. So where we sit at Sydecar is enabling individuals who have access to amazing private companies to invest in those companies and bring their communities along for that journey. So folks use us to create SPVs, and we have a turnkey fund structure for emerging funds to invest in a portfolio of assets. And most of our customers use us to invest in pre-IPO businesses that, maybe anywhere from 1 year to 10 years away from like an exit, really very early stage businesses all the way to some mature businesses. So to use Sydecar, you have to have access to those businesses, either because you're a founder, you're a product manager, you're a community builder, whatever you may be. You have access to founders who are building interesting things, and you have some unfair advantage of what you bring, and they want to have you on their cap table. You use us to move money into those businesses. So we're sort of like the first layer of like investing in private businesses. And then if you think about everyone who's interested in private businesses, that landscape is now growing, right? It includes everyone from folks who are sort of like the pioneer users of our product, all the way to retail investors who may be going into their Chase private wealth branch and speaking to someone about how can I get access to Anthropic or to OpenAI or whatever the company may be that they're interested in. And increasingly, those questions are happening to the point where even large banks are now thinking about how to create access to the more successful private businesses, because overall, there's an understanding that private companies will stay private longer. The benefits of going public are fewer. The cost is really high, and companies can raise in the private markets for a very long period of time. And the path to profitability is also something that's more achievable with newer technologies. So it may never make sense to go public for very large private companies. So if that's the case, how can retail investors get access to some of that growth of these private businesses? So what we've seen recently is large banks are buying up platforms that create that access to some of these large private businesses. So we recently saw an acquisition by Morgan Stanley of a company called EquityZen. Called Forge Global is in talks to be sold as well currently. And these companies are in the business of finding the more successful private company stockholders and connecting them with anybody who wants to buy those shares in the retail market. So we see that like everything from early stage investing all the way through late stage liquidity is kind of going through a little bit of a paradigm shift right now, where it's no longer atypical or kind of an outlier investment to invest in a private business. Now it's almost going to be part of everyone's portfolio going forward. And that's a very interesting shift for the private markets that I think happens in cycles. The last cycle it happened was probably a number of years ago, like 5 years ago, where it seems like it's becoming even more mainstream. And it almost feels like this is like the true paradigm shift. It won't be atypical, even in the next few years, if this cycle somewhat dips out a little bit, for people to still hold direct shares or some proxy of shares in a private business, not a fund, but a private business directly that they.
I think there's some of the things that I learned in running our marketplace. When we brought in investors new to the asset class of private shares, like they were sort of expecting some of the same like communication frequency and pricing that they would get in a public market, which they obviously didn't get with us. And I think there's an educational component for people new to the asset class. I think that still needs to happen, because if these are doctors, lawyers, and dentists coming into these deals, they're not really familiar with how long it takes actually, as you were describing, for a private company to have an exit.
For sure. I think there's an education component for those who are investing. And I think there's also an opportunity to work with the companies that are of interest to these doctors, lawyers, and dentists.
It's like a new form of investor relations. Yeah.
Exactly. Help them understand how the company is performing in a way that isn't at odds with their missions of staying private, right? And I think that these companies know there's sufficient demand for their shares. It's going to happen. How can we create some way for them to share updates, right, with those who hold shares directly or indirectly, that they know may get out, but it's still in everyone's best interest, because it creates a dynamic environment where they're bought into what's being discussed about them as an issue, as a company. And then those who are buying their shares understand what they're buying over the period of time they hold those assets, can more easily perhaps liquidate those as the journey continues for the business they're invested in.
You mentioned the EquityZen acquisition by Morgan Stanley. I think the previous cycle that we saw like Nasdaq buying a few of the companies in the space. Where in the future do you see private investors going to trade to find liquidity?
I think it's a good question, and there are a couple of ways to answer it. One is, where would most people go, right? And most people being like the retail market that
Go to
tends to
Schwab. Yeah.
they tend to be customers of a Schwab, uh, a Fidelity, um, increasingly folks like Robinhood, right?
Mm-hmm.
Where would they go to those same people, right?
Broker,
Those same
stockbroker. Yeah. Online broker.
exactly. So I think those companies are looking at these assets as like a means of creating that liquidity
Mm-hmm.
downstream. Um, and then there may be folks who invest really early in businesses, right? I think there's an opportunity for that sort of like pioneer type of investor where they might be investing in things that are well understood. They're not the Anthropics, where a Schwab might have an active sort of like market, if you will, at some point.
Mm-hmm.
Um, that I'm not sure of yet, but increasingly there are companies starting to like make it so that we can better understand why companies are valued what they are, which could maybe create more liquidity for some of those less understood companies. But I think for most people, the answer is clear to me, which is like they're going to go to that Schwab, that Fidelity, that Robinhood.
So I've been editor at Tearsheet for like 15 years, and we've seen multiple cycles, particularly around social investing. Every 5 years, like people forget all the previous lessons and say, hey, we're going to launch an investment tool to invest alongside your friends, right? And because that sounds like a great idea. These young people do it. They don't realize that like the road is littered with companies that failed doing that. But one thing I noticed that was interesting about your product, Nik, was we started using Sydecar after one of our partners had used it in another deal where he wasn't a lead, but he was an LP. There is a form of social investing, or at least social adoption around private deals, right? Because you typically you're 1 degree or 2 degrees away from the person that's putting the deal together, or the founder of the company. So maybe you could talk about that dynamic. Are you seeing other examples of that on the platform?
Absolutely, we see a lot of that on the platform, and a core value proposition of our platform is that it is a private experience. Meaning, if you are putting together a deal on Sidecar to share with your community, uh, you don't know who else is using Sidecar, right? You don't know which other GP sponsors are using Sidecar. You don't know which other LPs are using Sidecar. It's really just like an isolated experience for you, with a design to help you maintain your relationships in whatever way makes sense
Mm-hmm.
for you. What we do see, however, is that as our platform is more and more successful, um, those who might be limited partners who aren't putting the deal together, they see that it's convenient to do so, and they might talk to a founder someday and say, "Hey, I know a tool that can help me do this. I'm going to try it also and see if it works." That component does play out quite a lot. And then for us, it's there's a very strong referral component of, hey, if we do a good job for somebody, this is a tool that's almost like a commodity in a way. Like an SPV is a commodity tool. We want to be the best at creating those vehicles. So if we do a really good job, someone will refer us to their friend, a GP. That plays out a lot. Um, there isn't like an active social component that we're trying to nurture by saying, hey, like, you know, it's so easy that you should run your own deal, LP, right? Come back and use Sidecar. We don't do that actively because, again, our customers, we try to create like a almost Switzerland like product where you get to control that relationship in whatever way makes sense for you. But that does happen. It's not by design. It's
Mm-hmm.
just by trying what we do.
And what's interesting in your business model is also that so you're trying to reduce the friction on the opening of this entire process, but the relationship with the GP lasts. The structures are 7 years old, 7 years long. How many
And
years are 10 years exactly? So, like, can you talk about that component? Because as you built your model, you and your pricing, you also are keeping in mind that this relationship has to last 10 years.
absolutely,
May last 10 years. Yeah.
we assume it's going to last 7 to 10 years, right?
Mm-hmm.
But if you stay private longer, I think that timeline keeps shifting out. 10 years is kind of like an outer bound, if you will.
Mm-hmm.
Um, for that, of course, with our pricing, we take into account, hey, we got to like continue to do some work for 10 years for this SPV. How can we make sure our margins are healthy over the long
Mm-hmm.
tail? But we also see that our business is sticky, right? GPs who use us to create an SPV, they typically don't only create one SPV in their lifetime, right? They typically come back a couple times a year. And that's pretty interesting for us because it creates like a sticky kind of dynamic with our customers. Um, So again, we do think about the work to be done over the long tail. What's critical to me is that we honor our commitments of trust and credibility with our customers. Those are like the brand promises that we create and we want to honor. Um, and we're a financial services product, right? We're not a consumer product that can just, change our entire business model in 3 months and be like, whoops, that didn't work, sorry, right? So everything we do is with intentionality that, it has to work 100% of the time. There's a very high bar for brand credibility. These
Hmm.
relationships critical to our customers, the LP relationships and the GP relationships. And I come from a background as a lawyer, and my background's also in finance, where I understand some of the sensitivities around money movement and these like, the down to the wire type decisions you have to make. And that makes it so that for us, we're focused on the simple things, right? Just getting the job done, making sure when you talk to someone, it's really pleasant. Just kind of like the bare bones as like our mean of being the best, and less about the frills around like, how you might otherwise build relationships, right, with your LPs, which we think either other products can handle or you're just doing in WhatsApp or email or wherever that might be.
That's a good point. And what about your own funding history? I read recently that you did raise money recently?
We raised money a bit over a year ago,
A
was
year
our
ago.
Series A.
Hmm.
Yeah. But we've
Did you
raised a
use
few rounds of finance. Yeah.
did you use Sidecar to do it?
We did use Sidecar to do some of that. Yeah.
Okay, awesome. And so where do you see future product enhancements, or what are your plans for, 2026? We're almost there already.
I can't believe it. This year flew
Yeah,
by.
this year
But
it's like a blink. Yeah.
this picture I described of how the private markets are evolving, where
Hmm.
everybody is in, may have a stake of a private business. I think what's fascinating is that we're the touch point that might create that first exposure to that successful
Hmm.
private company, right? How can we offer those who invest in these private companies early a path, right, to work with like a Schwab or a Fidelity or a Morgan Stanley later, right? Um, to maybe create liquidity for that early position. And then RSPVs, which are a very standardized unit for investing in private markets. How can we take that infrastructure to more of the secondary movement that's happening today and be that infrastructure layer, not just for early stage investing, but for all liquidity that happens downstream? That's something I'm really passionate about figuring out. So I think our customer base will likely evolve next year from just early stage sponsors to also include brokers that are in this business now of exposing retail wealth to private businesses. And
Do
again, we
you,
want to stay right. So we're kind of in that
mhm.
infrastructure.
In the infrastructure layer, do you see any push or benefit, or any pressure to adopt some form of tokenization? Or we're
Great,
nowhere near there yet in private markets.
great question. Yes, I think those who are fascinated by blockchain as a technology frequently talk to us about, hey, like, what if an SPV were living on a blockchain?
Right.
Wouldn't that
And
be
then and that
great?
whole movement from where you guys start to exiting or trading, like that would make sense.
Yep. The reason that hasn't happened as quickly as you would expect, because it seems like an obvious use case, is
Hmm.
for the vast majority of SPVs, there's still fiat dollar movement through
Hmm.
traditional bank, which means that you have to honor each specific bank's compliance expectations, like
Nightmare.
KYC,
Hmm.
KYB. You as an SPV, if you're issuing an SPV, there's a fiduciary obligation between the
Hmm.
GP, which means that you need to know who your LPs are at every time at all
Hmm.
instances, and perhaps to disclose that information to FinCEN at some regular interval. Um, Beyond that, a key benefit of I think tokenizing things is transferability, right? If it's not an anonymity, it's transferability, liquidity. With securities that are unregistered, like SPV securities, you can't just freely trade them left and right in
Right.
America.
Right.
There are obligations for each trade, securities obligations that arise, um, which may be obviated if you're like a broker dealer, but even so, there's still securities obligations and reporting that needs to arise around that. So a lot of the benefits are somewhat distilled down and
Makes
then
sense.
apply, right? Um, the last thing I'll say is tax, right? If you're a stakeholder, you need to get tax reports for the stuff you hold for some period of time. maybe you could solve for that still, right? If it's a blockchain-based asset, but it helps to centralize some of this so that all of that can be done in one having a bunch of disjointed service works, because the ledgers on the blockchain and you could transfer whenever you want potentially. And then how do you ensure compliance is done a certain way, taxes are done and received a certain way? I think it helps to have one party to handle that can be accountable and has the right alignment around fee structure rather than having a bunch of disjointed providers.
Nik, thanks for joining us on the Tearsheet podcast today, and best of luck in 2026.
Thank you, Zach.